Why tokenized markets are forcing a rethink of counterparty risk. Counterparty risk has always shaped institutional markets. From bilateral trading to central clearing, financial infrastructure evolved to manage the risk that one party fails to perform. Tokenized markets are not removing that risk. They are changing where it exists and how quickly it appears, how counterparty risk traditionally worked. In conventional markets, counterparty risk is primarily temporal. Trades execute first and settle later. The gap between promise and performance creates exposure. Clearing houses, margin requirements, and netting arrangements exist to manage that window. Identity is explicit. Legal agreements define obligations. Disputes follow established processes. This framework works because time exists between execution and settlement. Atomic settlement changes the risk profile. Tokenized markets collapse that timeline. With atomic settlement, delivery and payment occur simultaneously or not at all. Settlement risk is reduced, but exposure does not disappear. It moves. Risk now concentrates in execution dependencies. Smart contracts must function correctly. Oracles must deliver accurate data. Custody and wallet controls must remain available. When failure occurs, it is immediate and binary. This is digital asset settlement risk, measured in seconds rather than days. Identity becomes less direct. On-chain execution often relies on pseudonymous addresses rather than named legal entities. This complicates traditional due diligence. Credit assessment can no longer rely solely on balance sheets and legal residence. Exposure must be evaluated through execution structure, control rights, and jurisdictional overlays. As a result, counterparty risk in tokenized markets blends credit, operational, and legal considerations into a single framework. Risk moves into code. In tokenized markets, risk is enforced by software. Smart contracts automate margin, liquidation, and settlement logic. This removes discretion, but raises precision risk. Code executes exactly as written, including its flaws. Security design, upgrade controls, and emergency mechanisms now function as counterparty risk mitigants, not just technical safeguards. From cleared systems to composable networks, traditional cleared markets concentrate exposure within known institutions. Tokenized markets distribute exposure across interconnected protocols. Assets depend on upstream contracts, liquidity pools, and governance decisions beyond any single counterparty's control. During stress, these dependencies can propagate rapidly. Counterparty exposure becomes a network problem rather than a bilateral one. How institutions are adapting. Institutions are not abandoning established risk discipline. They are translating it. Execution risk is separated from credit risk. Permissioned environments and pre-funded models limit uncertainty. Collateralized smart contracts and governance controls define fallback behavior. The focus shifts from token issuance to exposure topology, understanding how risk travels through on-chain systems. What this means for market structure. Counterparty design now determines scalability. Platforms that surface dependencies clearly, align execution with legal frameworks, and constrain hidden exposure are better positioned to support institutional participation. Tokenization does not eliminate counterparty risk. It demands greater precision in how that risk is measured and managed. Kenson Investments provides research and analysis to help institutions understand how atomic settlement, smart contracts, and on-chain execution reshape exposure in practice. If your organization is navigating tokenized market infrastructure, clarity starts with understanding where risk truly lives. Visit kensoninvestments.com and connect with our team.